PDAC 2026 Commodity TV is back here in Toronto for the largest and most important mining conference in the world. Golden times for commodity investors, and that's why we also want to start with gold and with the World Gold Council. And with me here is Joe Cavatoni, the what are you? The senior market strategist and head of public policy in the United States.
That's right.
Welcome here to Toronto.
Thank you.
Great to have you here. Thank you for taking the time.
Good to see you, Tim.
Thank you. So 2025 was a historic year for gold and gold companies. The gold price went to $5,500. The gold companies made a lot of money. Before we go into detail and look for 2026, could you give us a brief overview of the World Gold Council for the many new views we got in the last months?
So the World Gold Council's been around for quite some time. In the late 80s, we were formed by the world's largest gold mining member companies that put together the organization to focus on a couple of key factors and organizational drives. Number one, information, research, and data. Secondly, focusing on market structure and development. And third, all under the guise of making the market better so that people can trust it, trade it, and own gold with total transparency and confidence that they know what they own, and feeling good about the purchases and ownership of gold, whether it's a consumer or an investor, or for that matter, the use in technological developments.
Okay. So last year, 2025, we saw a combination of very interesting factors like ETF inflows surged. We had geopolitical uncertainties. We saw the central banks buying gold like never ever before. Has this changed since the beginning of the year? Is a turn, or what's the current situation on it?
Well, Tim, I'd say that things have gotten only much clearer, that those conditions that existed in 2025 will likely continue for 2026 and beyond. So at the heart of what was driving the gold price over the last 3 years is what I'd say has been risk and uncertainty, and those that can actually consume gold deciding it's the right kind of diversifier or addition to their portfolios. You'd mentioned central banks. We've had 4 years of record or near record flows by central banks diversifying into gold as a reserve asset, away from fiat currencies, including the dollar and the euro, but also just looking more broadly about what are the risks of owning US dollar assets. Some people like to refer to that as debasement. I'd argue that they're simply being prudent, and actually maybe that's a component of what they're thinking, but not only for domestic or for international utilization, but also domestic utilization. And on top of that, investors on a global scale, whether it's China, Japan, India, the Western markets like the US, Canada, are all looking to add gold to investment portfolios, diversifying away from riskier assets that are much more significantly impacted by the conditions that we're living in today.
Yeah, what we always hear is this de-dollarization. That means a lot of countries would change from their dollar to gold or other asset classes, and also a flow from the west to the east. That means from the Western countries to Asia or the Middle East. Can you confirm this?
Well, I'd say there's a few things to talk to in your question. The first I'd say is yes. We do an annual survey with central banks, about 70 plus central banks regularly, and they've been signaling to us their reliance on fiat currencies, the dollar, the euro, is going to continue to decline over time. Now, they've been looking at their homegrown concerns around their economy, their conditions that they're facing, whether it's inflation, stabilization of their own currencies, we have examples of those, or if they're looking at the risks that come along with holding treasuries or holding dollars. And this is where this condition of de-dollarization is being talked about, moving away from total dependency on it. And remember, when you look at commodities or precious metals more specifically, gold's approved by the IMF as an approved reserve asset. Silver, for example, is not. So even though they might be interested in that market, they can really only look to gold. But it's a global asset. And actually, to your point, the Western and Eastern investors have taken up much more gold over the last 3 years than we've expected to see for quite some time. Traditionally, Eastern investors were physical owners of gold. They still do own in the investment context, but jewelry is the area that's actually seen some slowdown in terms of tonnage demand over the last 3 years. And that's simply because these higher prices mean that consumers tend to buy less jewelry, even though what we're seeing as of the tail end of 25 is more dollars being spent.
Yeah,
So it's
for
an
sure.
interesting dynamic. So they're still saving, but they're not selling. The recycling is not happening that we would have expected to see. So there's definitely a gravitation to financial instruments, holding assets in portfolios, and being sophisticated around how gold fits into it.
So that means the positioning of both institutional and private investors hasn't changed that much after this great performance last year?
I would say that there's definitely increased levels of interest on the institutional side. And what I'd say on the retail side or the individual side is moving in Western markets back to the ETFs, and in Eastern markets, maybe away from something that has a savings on also an auspicious nature, but more to the financial products. So you see ETFs as an example in China, like leading the charge this year. The flows in the ETFs in Asia have been outpacing those in North America. So big investments.
Do you see any risks that could dampen the momentum in 2026?
There are a few factors for sure. Now, when we talk about de-dollarization, one of the things that I think is important is outside of the dollar, the choice for other assets as reserves is quite limited. You need liquidity, and that's where gold really does excel in terms of the role it plays, as well as with the dollar. But if the dollar has an opportunity to maintain its strength, the U.S. economy does land better than we expect, and there's good conditions that could play out that way, then we might see gold slowing down. But I wouldn't say it's necessarily a point of like turning the market. So we'll slow down and maybe look to see more conditions that are consistent with what we've seen in the past, and averaging about 8% on an annual basis. But right now, again, risk and uncertainty, and even with everything that's developing as we speak in terms of the Middle East, it continues to be paramount and one of the biggest driving factors, contributors to the price move. Risk and uncertainty, the movement in terms of people looking for safe haven. So for now, I'd say these conditions to slow us down are pretty less likely than what we would see to continue to see a strong market for gold.
Okay. To what extent does gold function as a strategic asset or a strategic allocation or a tactical hedge in this macroeconomic situation?
So gold is a huge market and trades globally, and actually the demand for it is wide-ranging in terms of the pools of capital that come after the market. And with that, we can be a technical or a tactical trading asset. And so we do see moments where momentum and speculation push the price. We had that in January where we had a 30% run, and that's when we hit 5,500. And people were pretty much taken back by that price because it was fast, high, unexpected, and likely driven by speculation and pushes. So it does play out in the gold market regularly. We had the correction off the back of that of down 20%. But where it's really starting to become more interesting for us is we're seeing investment consultants, pension funds, institutional investors, aggregators of retail, all looking and trying to identify what the allocation would be to a real asset that diversifies and performs correctly against risk assets like the Mag 7 stocks. When they're declining, what will hold its value? An asset like gold will do such a thing. When you have tariff noise, when you have tariff announcements and geopolitical risks are high, what can help you protect market risk there? And that's where I think the institutional and the strategic discussion of what's the right allocation is moving where we were from about 1% up the percentage allocation level, 2, 3, 5. Even some organizations in the US are suggesting that bonds don't perform well as that hedge in a portfolio like they might have done in the past, and are suggesting a 60-20-20 model of 20% bonds and 20% gold. So that's a high range for institutional and retail to be allocating the gold. But the number's out there.
Let's switch a little bit from the investment side to the other side of the medal, to the companies who are mining gold.
Yes.
They have high margins at the moment,
Yes.
3,000 to 4,000 margin. What's the current situation there, and what are the cost drivers for the next months?
Well, I think the all-in sustainable costs for the gold market have actually gone up, of course, obviously, as we've seen the conditions around the globe develop. But what I would say is that most of the companies are seeing that levered kind of impact from a higher price. And actually, it's an interesting time for sure for people to look at firms that can bring capacity online, whether it's brownfields or restarts of our existing products and projects, those types of environments where they can see the quick realization of this investment to a new project that could sustain some of this increased volatility, which we haven't talked to. Both gold, silver, they're seeing unprecedented levels and new levels of sustained levels of volatility. So when you think about investing here at PDAC in a mining company, you're going to want to look for a company that can weather a bit of that volatility more. So you want more quick, more to market type of production coming online. Now, production on average is growing at about that same range it has over the last 5 years at about 2%. And I think new project questions are being asked, like beyond the next 2-3 years, what does the horizon look like? Right now, it'd be interesting to see what we hear here at the conference. But again, because of the quickness that people want to bring capacity online, I think brownfields and restart projects are the ones that are actually catching attention.
What we always see whenever a commodity is rising in price is that companies like to step on the train and open up mines which have too much costs. Is there also fear that this would also happen at the gold space now, maybe also silver space?
Well, I think the way I'd understand that space and think to get myself educated on that space is to understand the dynamic that's playing out around the essence of what's playing into the political landscape and the geopolitical landscape around critical minerals and assets that are all interlinked together. And when I say that, what I mean is the gold market and mining for gold can yield other assets as well, whether it's antimony or silver or whatever the case may be. So this world of mining and actually where people are headed with their production and where they're going with new projects may have a higher tolerance for development and maybe a longer period of time for developing, maybe 8 to 10 years to see what can come out of a project that's underway. Because right now, the essence of critical minerals is at the top of every politics and political agenda, understanding who controls the assets, who has access to the assets, and how they're being priced. So I think mining's taking a shifting moment as we speak. And I think it's a really exciting time. And that might give a longer runway for people who can actually see more greenfield projects coming online. So to be seen, but I think it has to link back to critical minerals, where gold's not on that list for the US, for example, but it is essential and strategic. And you can hear that from the US administration, that it matters in the big scheme of things because they know that you can mine gold and bring other assets on the ground at the same time.
Okay. So, Joe, to summarize everything, what would you say should investors look for at the gold space for 2026?
I think there's a couple of key factors that people should pay attention to. Volatility and price moves and price swings are going to remain higher than maybe you would have expected or seen in the past, but that's not a problem. Secondly, the conditions for both risk and uncertainty and the potential for economic growth, which are the strategic drivers for gold, both remain strong. And I think that what is important is to understand the dynamic that it's not one factor. It's not just the dollar or not just US interest rates. It's a condition of structural shifts, central banks taking the time to actually properly allocate the gold and hold that as a liquid asset in their reserves. And over time, again, this asset will continue to see growth because the realization of risk offset and diversification in the portfolio is paramount right now.
Joe, thank you very much for this insight into the gold space, into the World Gold Council, and we keep all fingers crossed for 2026 for higher gold prices. And all the best for you and
Thank
for
you.
the World Gold Council.
Thank you, Tim.
Thank you. Yeah, ladies and gentlemen, that was Joe Cavatoni from the World Gold Council. You heard it. Gold is on fire. Gold will remain on fire. And therefore, I would say, have a look on gold. Buy some gold if you do not have something yet. So, and therefore, goodbye from Toronto.